Hello YouTube. So today I wanted to go through the IRS form W-8BEN. So the W-8BEN is one of a variety of IRS withholding certificates where an individual completes this, their name, address, tax ID numbers, tax residency, etc., and they provide that to a withholding agent. So a lot of times you would fill this out if you were opening a bank account, a brokerage account, if you had a client, or if you were a consulting firm, let's say in Europe, and you had a client in the U.S., they might ask you to provide one of these before they remit payment to you, just to make sure that you are, in fact, a non-U.S. company. And so for this video, I want to hone in on one very specific fact pattern where quite common nowadays is a non-U.S. person, let's say a resident of South America, Africa, Europe, Asia, wherever, and they want to open a U.S. brokerage account. So, account with, any of the big ones, so TD Ameritrade, Schwab, Fidelity, Interactive Brokers, whoever, all U.S.-based companies, or at least have U.S.-based branches, and so they want to open a U.S. account to invest in U.S. equities, right? So as part of that onboarding process, if this is an individual account holder, they're going to be requested to provide a W-8BEN, and it's very important that this is filled out correctly for two reasons. One, obviously you want to provide your broker as accurate a profile as possible as your tax status, but two, the big takeaway here is make sure that you are only being subjected to the appropriate withholding tax rate on certain types of U.S. source income. So what do I mean by that? So in the U.S., they have a withholding tax regime like a lot of other countries, where if you are a non-resident and you are being paid U.S. source income, a lot of times that U.S. source income is going to be subject to withholding tax at source. And so in this context, that really applies to the portfolio income that you're going to be earning in the brokerage account. So U.S. source dividends, U.S. source interest, and then capital gains on the disposition of those securities. So the base rate in the U.S. anytime dividends or interest are paid to non-residents is 30%. And so a lot of persons are subject to that 30% rate, but, and we'll go into this, if you are a resident of a treaty country, you might be subject to a lower rate. But it's important that you complete this section of this W-8BEN, the Part 2 claim of treaty benefits, to make sure that you get the full benefit of that treaty and you're subject to the reduced rate. And so we'll kind of explore the various types of U.S. source investment income that you can earn, what's subject to tax, and how do you try to reduce that tax or eliminate it completely by claiming treaty benefits. So if you're opening a U.S. brokerage account and you're a non-resident, capital gains across the board are not subject to U.S. taxes. That's very clear in the code and the regulations. So if you're buying a security and you, let's say you buy it and you hold it for 6 or 7 months and you sell it and you make $1,000 profit on the gain, that short-term capital gain is not subject to tax, and that applies whether you are claiming treaty benefits or not, right? That tax benefit applies across the board. Where it becomes more complex is if you're buying and holding securities for a long period of time and you're earning investment income on top of that, right? So like dividends. And so under normal, the default rules are, if you're invested in U.S. securities and let's say you can't claim treaty benefits and the stock you own pays you a dividend of $100, the broker is going to withhold 30%. Right, so if the company pays you $100, the broker takes 30, and they deposit the difference, $70 in your account, and then the 30 is passed over to the IRS as the withholding tax. Right, Now, if you claim treaty benefits, you can knock that 30% rate down. So that's what we'll go into here. How do you do that? How do you know that you are eligible for treaty benefits, and how do you illustrate that on this form? So the W-8BEN form is used for non-resident individuals. I'm using myself as an example here. I am a U.S. citizen. I'm not a resident of Switzerland, but I'm just going to pretend for the purpose of this exercise that I'm a non-U.S. person. I'm a citizen of Switzerland, right? So part 1, enter information about myself, name, country, citizenship, residency, my foreign tax ID number, date of birth. So that's all pretty standard. And then now we get down to part 2. So I know that if I'm investing in U.S. stocks and I'm paid a dividend, the base rate is going to be a 30% withholding tax. Well, I don't want to pay 30%. How do I get that rate down? Well, under the U.S. and Switzerland tax treaty, Article 10 covers preferential rates for dividend income, right? So let's jump over to the Swiss-U.S. treaty for a bit here. So the treaty is comprised of a number of articles covering various types of income and other rules. So Article 5, permanent establishment rules, is really important in a business context. And then we look at Article 10, 11, and 12. Now we get our FDAP income, or fixed determinable annual or periodic income. You'll see that acronym used a lot on the IRS website. So we know that if I'm investing in U.S. equities, I'm probably going to have some dividend income, right? And so let's look at Article 10. So we'll jump down there and see what Article 10 says. Okay, Article 10, dividends. Okay. So paragraph 1, pretty straightforward. It just says dividends derived and beneficially owned by a resident of a contracting state may be taxed in that state, right? And so essentially that gives the payor state authority to withhold tax at source. So paragraph 2 is what we need to cite as our relief here. So such dividends may also be taxed in the contracting state in which the dividends arise. But if the beneficial owner is a resident of the other state, the tax or charge shall not exceed 5% of the gross amount if the owner is a company and that holds at least 10%, or 15% of the gross amount in all other cases, right? So if we were completing a W-8BEN for, let's say, a Swiss GmbH, a Swiss company, that own stock in a U.S. company, and they own more than 10%, and maybe this 5% rate would apply, but in all other cases we're looking at the 15% rate, right? So that's what we're going for here. Is the default rate is 30. We're going to cite the treaty provisions to get 15%, right? So Article 10. Article 10.2b is our authority, assuming we qualify as a resident. That's our relief to get a 15% withholding tax rate rather than the 30. So residency is also very important. I mean, this is something that you don't want to get wrong. Let's see. So resident under this treaty is Article 4. So you look to Article 4. If you were a Swiss citizen and resident, you would look to Article 4 and the conditions therein to make sure that you actually qualified as a resident under this treaty, a resident of Switzerland. Because otherwise, you might not apply. The other issue here with a lot of U.S. treaties is the limitation on benefits provisions. So assuming you're a resident under Article 4 and Article 10 applies, you then need to look at Article 22 to make sure that you satisfy the limitation on benefits provisions, because that's kind of like I guess a last line of defense for the U.S. government when it comes to reduced withholding rates. So that they'll provide you the lower rate, but if you fail the LOB provisions, they won't give you that reduced 15% rate, right? They'll make you subject to the 30% default rate. So you're looking at all 3 articles here to make sure you qualify as a resident, the dividends provisions are appropriate, and then you pass the limitation on benefits provisions as well. But assuming all of those are met, and again, I would highly recommend you consult with a tax advisor to make sure all these all these are apply to you, because you don't want to put something down on the W-8BEN that is not accurate. Okay, so if we jump back to the W-8BEN, so Part 1 is pretty standard. Everybody's going to fill this out, whether you're asserting treaty benefits or not. If you are going to be asserting treaty benefits under Chapter 3 to get a reduced withholding rate, then you would complete Part 2. Right, so I am representing to, let's say I'm opening an account with Interactive Brokers. I'm representing to IB that I am the beneficial owner and a resident of Switzerland under the treaty, and I'm claiming the provisions of article and paragraphs of Article 10.2b of the treaty to get a 15% rate of withholding on dividends rather than that default 30%. And so this would be the withholding certificate I would provide to the broker when I open my account, so they know that, okay, yes, I am a foreign person, so broadly I'm going to be subject to these non-resident withholding rules, but I'm claiming treaty benefits under this article. So if I'm buying and selling stocks and U.S. equities, let's say I'm going long on certain equities, so I'm going to buy and my plan is to buy and hold for a couple of years, right? I'm looking for the appreciation, and some of those might be dividend-paying companies. I don't want to be subject to the 30% rate, right? I'm gonna save half the tax by claiming, the preferential rate under the Swiss treaty. So, in a lot of cases, you'll have individuals completing multiple W-8BENs, right? So there was the other provision there you saw for interest. In certain cases, you might provide one of these for the dividend income and then a separate one for the interest income. But again, that's limited cases. If you're investing through a broker or a bank, interest normally isn't subject to withholding at all anyway, because it falls under what's called a portfolio interest exemption, which means that if non-residents are investing in those types of debt instruments, the interest is exempt from withholding tax anyway. So most of the time you're gonna be completing this type of W-8BEN. If you're opening a brokerage account with a U.S. company and you're a non-resident and you're in a treaty country and you qualify, this is broadly kind of how you would complete this form, right? You're trying to get the preferential rate for dividends under whatever applicable article and treaty you have that applies to the situation. And so, of course, Part 3, read through these certifications. You're attesting to all of these are complete and accurate, and you've done a thorough review. So, again, I think in certain cases you can be pretty confident that you'll be a resident and a tax resident of a certain country, but there are cases where you might be kind of in a tiebreaker type of situation, so you want to be very careful with claiming treaty benefits if you're not sure that you actually qualify for them. So I would recommend consulting with international tax practitioner that is familiar with this space, so they could properly advise you. Okay, so that covers it. I mean, you can see it's a very simple one-page form for individuals, but there can be a lot of moving pieces, particularly in this Part 2 section, to see whether or not you qualify. But thanks for tuning in, and if you have any questions, please leave a comment on the video or shoot me an email. Happy to respond and help you with any kind of questions you might have. All right, thank you for listening, and everybody take care.